Okay, everyone, can you see the screen? Okan Company, a large listed company located in Y, whose currency is the YS, manufactures engines and engine parts. It is considering whether or not to invest in one of its one of two new 4-year projects. One is the project Alpha and the project Beta. Details of the both projects are given separately. Obviously, Okan company has used a relevant adjusted discount rates to calculate the NPV of the projects. So, examiner has already calculated the NPV of these projects. However, the finance director believes that calculating the APV of the projects would be more appropriate. The fund company wants to base its decision on which projects to invest in, on the returns generated by the project's risk as measured by the project duration, and important non-financial aspects. Both projects are due to commence in 6 months' time. So in this question, what the examiner is saying, the Khan company wants to base its decision on which projects to invest on the returns generated by the projects. One is this. The project's risk measured by the duration. So in this question, we are going to have a discussion on the duration topic as well. Now, project Alpha or project Beta will each require the same amount of initial funding, 550 million. Now, in this question, remember, Okan company home currency is the YS. Now, proceeds from the sale of a factory based in Europe in 6 months' time for Euro will provide part of the funding. Meaning, if this funding is required as 50 million, so what will happen if you want to have the 50 million? So some amount when you are selling your factory in 6 months' time for 10 million, this will provide part of the funding and the balance will be financed by debt borrowing. So we will see that when we will convert these euros into the YS, so how much we are going to have and the balance we will be borrowed. Okan company expects to hedge the euro using either forward markets or money market. The following information is available on these markets. Examiner has given you the foreign exchange rates, the spot rates, the forwards has been given, as well as the examiner has given you the investing and the borrowing rates of the euro and the other. Now, the balance, now this is very important. See, what is happening? I am giving you an example. For example, we required the 100. From the 100, the 50 we are generating from the sale of something. And the 50, which is now, that will be financed through the loan. So this 50 information the examiner has already given above. This 50, the balance by domestic borrowing will be a 4 years subsidized loan on which interest is payable 2.1%. And Okan company normal borrowing rate is 5%. Issue costs relating to raising this finance will be 3% of the gross proceeds. Now, the other project, that was the project Alpha. Project Alpha base case NPV and APV in 6 months' time when the project will commence should be estimated using the following information. The sales revenue and production costs relating to the project Alpha in 6 months' time before annual price or cost increases. Before any annual price or cost increases are as estimated. Examiner has told you the sales and the production cost. Now, examiner is telling it is expected that the sale price will increase at an annual inflation rate of 10% and domestic production costs are likely to increase by Y's annual inflation rate. So we have to inflate them as well. Now, in addition to above, the components will be imported from the UK, the falling current cost. When you are going to have the components imports from the UK, so they have the component cost in the pounds. The cost of the component from the UK are fixed and not subject to any inflation. Now the funds of Y50,000 for the project Alpha will be used to purchase plant and equipment needed for manufacturing purposes. Tax allowable depreciation is available on the value of plant and equipment on 25% per year on a reducing balance basis with the balancing allowance of charge at the end of the project. The plant and equipment is expected to sold for YS 10 million at the end of the project. Now, at the start of every year, Project Alpha will require working capital. In the first year, the working capital will be the 10% of the estimated year one sale revenue. In subsequent years, the project will require increase or reduction in working capital of 15% for every dollar increase or decrease in the sale revenue respectively. The working capital is expected to be fully recovered when the Project Alpha ceases. Now, the expected spot exchange rate between YS and the pounds in 6 months' time is expected to be 3.03 per pound. Why, guys? Because examiner is confusing you people. Examiner is telling you people that you are importing a component from the UK. So what will happen? You have to convert the pounds into the home currency. That's why examiner has given you the spot rate. The annual inflation rates are currently 2% in the UK and 4% in the Y. It can be assumed that inflation rates will not change for the foreseeable future. The cost of capital for appraising the base case NPV of the project Alpha is 10%. Okan company pays tax at an annual rate of 20%. Tax is payable in the same year and the profit is based. Okan company makes sufficient profit from its other activities to take advantage of any tax loss. Meaning, if there is a tax loss in any year, you can claim the savings on that. This was the project Alpha, now the project Beta. Given below the project Beta specific base case present values based on the project start dates in 6 months' time, discounted at the project's relevant adjusted all equity finance discount rate. So, examiner has given you the base case present value already given. So the present values are this. It can be assumed that any working capital for project Beta are included in the annual cash flows. Project's Beta duration has been calculated as 2.43 years based on its present values. One of Okan company's subsidiary company in Y, which produces and sells its product domestically, has still found that it is exposed to economic risk. The directors of the subsidiary believe that this is because Y's government has maintained competitive higher interest rates even though the inflation in Y is now under control. Okan company categorized the risk inherent in its projects according to the severity and their impact and the frequency of their occurrence as follows. Severe and frequent, not severe but frequent, severe but not frequent, neither severe nor frequent. A part of the question. Examiner is asking you people discuss why a company may prefer to use APV method rather than the NPV method. So this is basically a comparison. The examiner is asking from you people to make a comparison between the APV and the NPV. The second, prepare a report for the board of directors which estimate the minimum amount of debt borrowing the Okan company would require. Because we said if the 50 million is or 100 million is total, the 50 you are getting from the sales, let us assume. So in this question, we have to tell the examiner how much balance we will finance with the help of the debt borrowings. Then for the project alpha and beta, base case NPV in 6 months time before considering the financing effects. And then project alpha and projects beta APV in 6 months time. And then projects alpha duration based on base case net present value cash flows. Very good question. And then evaluate and justifies which project Okan company should choose, being the decision on the factors Okan company considers to be important. Because in this question, we said that the decision should be on the duration, on the returns generated by the projects. The valuation should include a discussion of the assumptions made and discuss why Okan company subsidiary company may be exposed to economic risk and how it may be mitigated. 4 marks. And discuss how each category of the risk in terms of severity and frequency can be managed. Guys, I will say the best question which is covering your APV, your forex as part with the hedging, and in this question you people are going to have a discussion on the duration topic. So very important question. Everyone, please open the question. Neola has already sent the question in the group. Hurry up, everyone, open the question. And guys, I need every student participation in the class. If you people are just silent in the class, it also gives me the demotivation. Please, I need everyone's motivation in the class. So who will be doing this question with me, guys? Who will be performing the calculations? Tell me. No one?
Hey, Paul. Someone say. Which one is I say?
Please keep muted.
Who
Who is this? Peter.
Okay.
Okay, Miss Rafia, you will perform the calculations?
Yes, sir.
Okay, well done. Okay, guys, let's first start the numerical portions and then we will come towards the theoretical portions. Now, guys, examiner was asking from you people that you have to tell that how much is the borrowing requirement. How much is the borrowing requirement? Now, everyone, can you see the spreadsheet, everyone in the class? Tell me.
No,
Guys, can you see the spreadsheet?
no, it's not there.
No.
Okay. Now can you see?
Yes.
Yes.
Now see, guys, this was our funds required for the first project. Now we said that for these funds, we are going to have the first part from the sale of a subsidiary, and the sale was in the euro. Now, examiner, in your question, provided you people the two derivatives to hedge this foreign currency. One was the forward and the other was the money market hedging. So guys, if you will apply the forward, examiner has given you the rate as 2.5462. This was given. Okay. Before I move on, how many of you still have any difficulty when to decide that which rate to choose? Like in this question, you people have been provided the two rates for the forward, and out of these two rates, we have selected the 2.5462. Anyone in the class who is having the issue, sir, why we are having this rate, why we are not having the other one? Anyone in the class who have this issue? Tell me, guys. No one? Okay, Carmen. Carmen, can you hear me? Carmen, can you hear me? Okay. Guys, tell me, what was the spot rates given? Ms. Rafia, what was the spot rates given?
2.5210, 2.5862.
2.52.
10.
And what was the other rate?
2.
Carmen, what is happening? Okay. What was the other rate, guys?
5862.
And the currency denominations are Y dollar over euro.
Y dollar per euro.
Now, what will happen, guys, when you are solving the currency questions? Always consider yourself in adverse position. Adverse means if you are a borrower, you will say, oh, sorry, if we have to receive the foreign currency, we will say we will receive less. And if you have to pay foreign currency, you will say you will pay higher. Now in this question, what we are doing, we have to receive or pay. Tell me. As you are selling a subsidiary, so you are going to
Receive.
receive, and receipt should be less. So that subsidiary you sold for how much? What was the amount? What was Y dollar? Euros. Subsidiary sold for how much euros?
10 million euros.
10 million euros. Now see, guys, if you want that this should be in our home currency, Y dollar. So the euro and this is dollar per euro. So definitely you will multiply, because when you will multiply, this is Y dollar, this is euro, the euro will cancel. And you will get the answer in the Y. But to receive less, definitely you will choose which rate? You are multiplying. So when you will multiply with the 2.5210, you will get the less receipts. So that's why we are having 2.5210. Understand? Rafia, understand?
Yes.
Now,
Yes.
but as now we are using the forward. So in the same technique we are using for the forward rate. We will choose that forward rate in which our receipts will be lower. So we choose 2.5462 and our expected receipts are in the $5 that are coming as 25462,000. Now, if you will apply the money market hedging, so first of all, whenever you have to apply the money market hedging, you have to see whether this is a borrowing case or this is a payment case. Oh, sorry, receipt case or payment case. So guys, tell me, this was a receipt case or payment case? Well, this is a receipt case definitely because as we have sold a subsidiary, we are going to receive the dollars. We are going to receive the foreign currency. So guys, whenever you have the receipt case first is you have to calculate the present value of the foreign currency. See now how this is coming. Our foreign currency was 10 million euro divided by 1 plus borrowing rate of foreign currency. What was the borrowing rate which was given to you people in the question? That was 2.20, but that rate was annual. We are going to receive this money in 6 months' time. So we are having 6 over 12. The 2.20 was given to you people as an annual rate. We have converted into the 6 months. So this will be the present value of the foreign currency. The second was you have to, the second was you have to convert this foreign currency into home currency using the spot rates. Now see guys, this was the foreign currency present value and the 2.521 spot rate was given. So you will convert this into your home currency. And the third step is you will invest this. Now, as you are investing, but remember, investment is in your home currency. So you will choose the lending rate of your home currency. In the question, if you will say the YS lending rate was given to you people as 0.024. But again, this was annual rate. You will convert it into the 6 months. So now see the final answer is 2523935. So as this was a receipt, so which the forward or the money market hedging out of these two, which is giving you the higher answer, guys? Tell me, Miss Rafia. Which is
Forward.
giving, so as the forward is giving us the higher answer, so we will say that the 50 was required, out of which the 25462,000 we are getting from the sale of a subsidiary. So this balance will be available, which you will borrow. Understand? Understand everyone? Neola,
Yes.
Gentrix. Gentrix, understood? Okay, now. Now, the second part was we had to compute the base case NPV of the project Alpha. What we had to do, guys? We had to compute the base case NPV. Now see what is going to happen for the project Alpha. The sales was given to you people in the question as 17, but examiner told you that the sales has to be increased by 10%. So see, what is going to happen? This was the sale which was given. The sale was given. Tell me, guys.
Yes.
So what we are doing? We are applying the inflation. Then for the second year, this 28350 was given, and again we are inflating it. In the same way, we are inflating it up to the last year because the inflation rate was already given as a 10%. Now, for the cost, what was the cost inflation? Tell me, by which percentage we had to inflate the cost? What was that?
4%.
So we will say this is going to be inflated with the 4%. So see, the cost which was given to you people in the question, that was 6120. We are inflating it by 4%, 1.04 raised to power 1. Now, this is the same criteria we are opting. The 2 years inflation. Then for the last year, you see that 8160 was given in the question, 1.04 into raised to power 4. Understand? Now, let us talk about the component. Now, this was the understandable point. The component cost. The component cost was given you people in the pounds, but you are making the base case NPV in the Y dollar. So it's mean that there should be exchange rates which will convert the pounds into the dollars. So examiner has given you the current spot rate, then the inflations were given. So we can compute the future spot rates. What is the formula? Current spot rate into 1 plus inflation of first currency divided by 1 plus inflation of second currency, as YS in the numerator. So YS inflation 4% will be above, and euro is in the denominator. So euro inflation will be on the lower side. So the year 1 future spot rate is 3.089, and then you can compute for every year. This will be spot now and 1.04, 1.02. So we can compute. Now, if we talk about the component cost, guys, what was the component cost? Can you tell me, guys? In the GBP, this was given as 1200, 1800,
Yes.
3700, and 1400. This was given.
Yes, it was given.
Now, what will happen? You cannot put these pounds figures because you are making your data in the Y dollars. So what is happening? We have now the conversion rate. This was YS over euro, and this was 3.03 was YS over euro or YS over dollar. Tell me, Rafia. 3.03 was YS over euro or dollar?
YS or euro. YS per euro.
Okay. Now, what will happen? See now, this was given into the,
Excuse me, sir. Is that euros or pound sterling?
I think that this must be in the YS over pounds. Rafia, see it. Neola, see.
Sorry.
The exchange rate currency denomination was what? It was YS over euro or YS over pounds. This is, I think, YS over pounds.
I think it depends with it's the question, because the original question was in euro, but the revised one is in pounds.
No. See, everyone. See now. We are talking about this was 3.03 YS over pound. This was given. Okay. So now what will happen? This was in the pounds. This is YS over pound. So multiply this figure. How this figure is coming now? See now. This multiply by this. You have converted all the GBPs into the YS. And this 3707 we are having here in our computations. Understand? Now, for the tax allowable depreciation, examiner told you people that your value is how much? 50,000. Your value is how much? 50,000. And we are computing, as examiner told you people, that there will be a balancing allowance or charge. What was the cost of this plant and machinery?
50,000.
50,000. So first year, how much allowance was there? 25%.
Yes.
So we have taken the 25%. So this is the balance available. Now again we are having how much? 25%. This is the balance available. How this is coming? This minus this. Now upon this value we are coming the 25%. Now in the last year, what is going to happen? At the end of the last year, the written down value was coming as 21094. And examiner told you that what will be the realizable value. Guys, what was the realizable value?
$10 million.
How much?
10 million.
10 million? Tell me, guys.
Yes.
So it
Yes.
means that what will happen as we are taking the 1000 common. So you can state here the 10,000 was the written down value. But what is happening? Our asset was having a worth of 21094 and we are selling the asset for 10,000. We are selling the asset at a loss. So tax authorities will provide you some support. They will be giving you a balancing allowance. To see how allowance is being computed, our value was this, and we are selling the asset at 10,000. This is the balancing allowance. These values we will copy paste into the above performer. This is the values. Now you will compute the figures. These are your taxable cash flows. Now apply the tax. In this question, examiner stated a hint. Examiner told you people that the other profitable projects are available, so you can claim the savings on the loss. So as this was the loss, so we are claiming the saving on that. And in the future years, we were having the profits, so we are paying the tax on that. Understand?
Yes.
You will add back the depreciation which has been computed here. First we deducted, now we will add back. So now this was your working capital. How the working capital we are claiming, the examiner told you people that for the current year, the working capital will be the 10% of the sales. So we are having this. Then examiner said, whatever the increase will be, first we computed the increase. So for every $1, the 15% will be the working capital. So we are computing this. Why this is positive figure? Because now see guys, what is happening? Year 3 and 4. In year 4, our investment is going down. We are not putting the funds. So that's why it is now positive. And by the end, all this will be recovered. This was our initial investment. This was the scrap value. Now, the discount factor 10% was given. So this is the present value and this is the base case NPV. Now, if you have to get the marks for the spreadsheet functionality you have to apply, then you will be getting the marks for the analysis and evaluation skill. Just you will compute here the base case NPV. How you can compute is equal to NPV. It is saying to you what is the rate. So tell him the rate is the 10%. Now it is saying what are the values, comma, select all the cash flows. These are the cash flows. Bracket close, then plus add the negative. The same NPV is coming. Tell me guys. So in your exam, why you people are not applying the spreadsheet function? Why you are going for this complex calculation that first you are computing the discount factor for every year and then you are computing the present value? No. If the examiner has created the ease for you people, just utilize that. And that's it. Clear?
Could you please come again on the formula?
The formula is you will type is equal to NPV, rate, comma, positive cash flows, bracket close, then add the negative one. Okay. Now, the other part of the question in which examiner was asking for the project beta APV. You people were very lucky that examiner has already computed these present value of the cash flows. This was computed. Tell me, the 50,000, 8450, 919360. This was computed. Neola. This was computed by the examiner. Rafia, tell. Gentrix.
Yes.
So just you have to apply the sum of this. This was the base case NPV because already the present values was computed by the examiner. That's it. We do. Now, the next thing was the financing side. Now you will finance those amount which in the A part of the question we said we will be going through the debt financing. How much was that amount? This was the borrowing. 2453800. This we will now finance with the help of the subsidized loan. Now, what is happening? as this was the borrowing requirement and what is the issuance cost. Examiner told you people that issuance cost is 3% of the gross finance required. So what is happening, guys? See now, this divided by 0.97 and then we are taking the 0.03. Or if you want to compute it another way, just take this amount divided by 97 multiplied by 100. Now this is the total figure and this is the gross amount. And how you will compute the issuance cost out of this gross, deduct the original. Sorry. This minus the same figure is coming. So the gross you have computed. Now, guys, remember, whenever you are having in your exam the subsidized loan calculation and the tax is payable in the same year, so there will be the first calculation that is known as the present value of tax saving on interest. This is the formula. This is the tax savings. How we are taking? See now, you will take your borrowing requirements into tax rate into interest rates. What is the formula? Amount of loan into interest rate into tax rate. Now, many times the students are confused. Many times the students are confused, and now I am going to rectify your biggest problem. See guys, here in the financing, when you are computing the tax shield, so in the calculation, you have taken the loan amount as 24538. Now the question can arise, sir, instead of 24538, why you have not taken the gross amount, which was the 25296? Because in some question, examiner will use this gross amount, and in some question, the examiner will take the original amount. Now remember, guys, the rule. Whenever you are saying that the issuance cost is payable out of the cash reserve, then only the 24538 will become the part of your next calculations. And when it is stated that the issuance cost is payable out of the external financing, then the whole amount 25296 that will become the part of your calculations. In this question, as nothing was stated, so we are using an assumption that the issuance cost is payable out of the cash reserve. That's why as that 758, we are already with us in the form of the cash. So only the 2453 are, we are going for external source of finance. But if you people take the value, the 25296, that is also valid. You will state in the exemption that I am assuming that the issuance cost is also payable out of the external financing. Then the 24538 plus 758, which is equal to 25296, that will be there in your further calculations. Everyone clear?
Yes.
Now, this was the tax savings. We have to compute the present value. Now, one more thing. To get the present value, you can use the risk-free rate or the cost of debt. That is your own choice. Like in this, I am using the 5%. What was the 5% in this question? It was the cost of debt or the risk-free rate?
Cost of,
It was the normal cost of debt.
yes, normal borrowing.
So instead of this, if you people will use the risk-free rate, that is also acceptable. No problem. So this is the formula 1 minus 1.05 raised to power minus 4 divided by 0.05. So this is now the present value. Now, when the tax is payable in the same year, so the next formula is present value of after tax interest loss. What is the next formula? This is. What is this formula, guys? Now see. Amount of loan into normal loan rate minus subsidized loan rate into 1 minus T. What is the formula? Normal loan rate into, sorry, amount of loan into normal loan rate minus subsidized loan rate into 1 minus T. Again, the same annuity factor. This is the present value and this is the total of the financing side. But one thing which you should remember, guys, what is that? If in this question it had been stated that the tax is payable in the areas, then this step you cannot solve it in a single way. Then you had to solve it in the two ways. What was that? First was, I am going to elaborate more and more for you people. What will happen? I am telling you people, if in the exam the text was payable in areas, then in the case of the subsidized loan, the first calculation will be the same, present value of tax saving on interest. The other calculation will be present value of interest saved, and the third calculation will be present value of tax loss. But if the tax was payable in the same year, then these two steps will be performed together and we name them present value of after tax interest rate, which we are following in this given question. Understand? And what will happen? Should I write down the formulas for this as well, guys? Tell me. Rafia, do you need the formulas?
No, sir.
Anyone else who need the formulas for this, for these two? No one?
Yes, please give us. Please give us.
Amount, normal loan minus subsidized loan, then multiply by annuity factor multiply by discount factor of year one. And here amount into subsidized loan rate into tax rate, annuity factor, discount factor of year one. And this will be amount into normal loan rate minus subsidized loan rate into tax rate multiply by annuity factor multiply by discount factor of year one. Here no discount factor of year one, guys. Why? Because no tax here. The discount factor of year one, why we are multiplying with this? Because of the delayed arrears taxations. In this formula, no taxation impacts, so there is no need to further multiply. Now, this was your financing side. Now, what is going to happen? This was the base case NPV for this, and this was the base case NPV for beta. These are their financing sides for the alpha and beta. So these are their APVs. So based on the calculation, the project alpha seems much better because it is giving 6,888 APV and the other one is giving 6,725. Now the one project duration was given and the other we have to compute. Which duration was given, guys? Can you tell me? Which project duration was given?
Betas.
The beta was given, the alpha we have to compute. Now, guys, if you have to compute the duration is just a step-by-step approach. What you will take, you will compute this we have already computed, the present values of this project. This we computed. Above, you will state them and beside that, you will have the total of them. Now, the second step is you will calculate the proportion. How you are computing the proportions? Total amount divided by the current year amount. Like in the last year, total divided by the current year divided by the total. This is giving you the fraction. Then the next step is the weighted average. The first year figure you will multiply by the 1. This second year, so multiply by the 2. This is the fourth year, so multiply by the 4. Then you will add them. So this is the duration of this project, which is coming as 3.04. So this was 3.04. This was already computed by the examiner. So good question. What do you say, guys?
Yes, sir.
Okay, now let's solve the theoretical portion. Can you see the screen? Now see guys, what is happening? Examiner is asking you people in the A part the difference between the APV and the NPV. Those students who are my paid students, they already know that in the APV, what is happening? APV separate out projects cash flows and allocate a specific rate to each type of the cash flow. First of all, you will tell the examiner the separation. And then we are having a specific discount rate to each cash flow dependent on the risk attributable to that cash flow. NPV discount all the cash flows by the average discount rate attributable to the average risk of the project. First of all, this is the difference. Now, one reason why APV may be preferable to NPV because by separating out different types of the cash flows, the company's manager will be able to see which part of the project generates what proportions of the value. Like we have distributed APV and financing side. All the cash flows which are relating to the finance that are being dealt here. So in this example, Okan company is able to determine how much value is being created by the investment, mean from this base case NPV, and how much by the debt financing. For example, projects investment related cash flows could be further distinguished by their constituent risk factors where applicable. So it was a very easy. Now, as the report, so their report should be an introduction report to the board of directors of Okan company. Now, when you are evaluating, now using forward markers to hedge the expected receipts in 6 months' time results in high receipts. We have computed. And guys, remember, whenever you are performing the calculations in those spreadsheets, must provide the examiner that where you have computed the calculation. Like in this, we said that the calculations have been produced in the appendix 1. Using forward markets to hedge the expected receipts would therefore minimize the amount of debt borrowing. However, the amount receivable from the money market hedge is based on the annual bank investment rate 2.4. Okan may be able to use the funds borrowed to generate a higher return than the bank investments, and therefore using money market to undertake the hedge may be financially advisable. The Okan company should investigate any opportunities for higher income, but based on the current result, the forward hedge is recommended to minimize the amount of the debt finance matter. Do you see that? What was happening? We have to choose between the forwards and the money market hedging. Based on the calculation, it is quite visible that the forwards are giving the better results because they are giving 25462. This was giving 25234. But just to say this, that is not enough. Examiner is saying that the Okan company is going to invest. Annual bank investment rate was 2.4%. Okan may be able to use the fund borrowers to generate a higher return and the bank investments than the bank investments, and therefore using money markets to undertake the hedge may be financially advisable. We are not saying it is a now. We are saying it may be financially advisable. We are trying to apply the skepticism skill. Now, this was the project alpha and the project beta, which we have performed already. Now, project alpha and project beta base case NPV and APVs are similar to each other. See now, the base case NPV and APVs. They both are almost having the same. However, both projects betas duration is significantly lower. This is lower. This is because higher proportion of the beta's cash flows come earlier in the project's life compared to project alpha. Now see, this is very important. What is examiner saying? Why this period is lower? Project beta, why it is lower? So where the project beta calculations we perform? See now, guys. This was the project beta. Where it is uh, see this one. Project beta. Base case NPV of the project beta in the appendix 2A. Where the appendix 2? Appendix 2. The beta. The beta duration was coming lower, and the project beta. See now, what is happening, guys? This project cash flows are the 19,360 and 22,340. We are having these cash flows in the earlier years of the project. It's mean that this project is recovering its cash flow soon. That's why its duration was coming lower. When the duration answers are coming lower, it's mean that the project is recovering its cash inflow sooner, and this project is recovering its cash flows later. Hold on, guys. Now, guys, this is because a higher proportion of the beta's cash flows come in the earlier year compared to the project alpha. There is more certainty to earlier cash flows, and this is reflected in the lower duration of the project beta. Project beta risk is lower than the project alpha because that project is recovering its cash flow soon. That's why its duration is coming as lower. Now, in estimating the base case NPV and the project for alpha, it is assumed that the cash flows are known with the reasonable certainty and the inflation rates will not change during the life. It is also assumed that the future exchange rate between bias and the pound will change according to the purchase parity. Furthermore, it is assumed that the prices and the cost letting the project alpha will increase in line with the inflation during the 6 months before the project start. For the project alpha, it is assumed that the initial working capital requirement is funded by the company and not from the fund raised from the subsidized loan, similar to the assumption made for the project beta. However, for both projects, Okan company needs to consider and take the account of opportunity cost related to this. In terms of the project alpha, discount rate, it is assumed that the given discount rates actually reflects the business risk of the project. So what we are doing, we are describing the assumption which have been used in the question. While this level of detail is not provided for project beta, which is assumed that the similar assumption will have been made for the project beta as well. In the case of both projects, Okan company should assess the accuracy of reasonableness of the assumptions and if necessary, conduct sensitivity analysis to observe how much the project's values change if the input variables are altered. Notwithstanding the assumption and caveats made above, it would appear that the project beta would be more preferable to project alpha, given that it has a similar APV and that is significantly lower risk. So now when you are recommending, you are getting the marks for the evaluation that out of this project which should be accepted. Nevertheless, there may be a good strategic reason why Okan may select project alpha over project beta. For example, the reasons may include providing access to new markets, enable Okan company to react barriers to entry against competitors, or looking to follow on opportunities as possible real options. But then you have to give the conclusion and the report compiled by and the date. Now the last part of the question. Now guys, remember in your course, examiner will be asking you people the 3 types of the risk. One is known as the transaction risk. To manage this transaction risk, we apply the derivatives. Like we apply the forward futures. Then there was a translation risk. The translation risk is just a bookish entry. And the third one is the economic risk. The economic risk is a long-term risk. It cannot be managed by any of the derivatives. Now, companies face economic exposure when their competitive position is affected due to the macroeconomic factors such as changes in the currency rates, political stability, or changes in the regulatory environment. Long-term economic exposure or economic shocks can cause a permanent shift in the purchasing power and any other parity conditions. Normally, companies face economic exposure when they trade internationally. However, even companies do not trade internationally nor rely on input sourced internationally may still face economic exposure. Now, this was the basically the definition. First, we are saying that one the economic exposure is when there is a competitive position affected due to the currency rate fluctuations, the regulatory environments are changing. Now, how you will relating to the question? In the case of the Okan company, subsidiary company economic risk may have occurred because interest rates have been kept at a higher level, causing the original parity conditions to break down. High interest will attractive to international investors as they can get higher returns and may lead to YS becoming stronger relative to the other currencies. This in turn would allow international competitors to produce goods more cheaply than subsidiary and thereby enhance their competitive position relative to the subsidiary company. Now, what is happening? The Okan company government, they have increased the interests. What will happen? The foreign investors, they will be attracted. They will want to do the investment in the Okan company's country. But the foreign investors, when they will do this, so our competitors which are there in the foreign countries, they are sitting, they are watching that this company is getting the benefit. This country is getting the benefit. Why? Because the foreign investors are attracted. Now, what strategy they will play? They will start to produce the things at the cheaper prices so that the investors, they are not going into other countries. They are there already in which our countries they will start buying the cheaper products. Previously, they were not like this because they are moving towards in that countries where they were finding the products in a cheap price. But now, just what is happening, just to cater this economic risk, our competitors, they will be producing the cheaper products than our subsidiary company. So it will be an economic risk for us. So how this will be, managing exposing economic risk is difficult due to its long-lasting nature. Financial instruments such as derivatives and money market hedges cannot normally be used to manage. So foreign company, subsidiary company tried tactics such as borrowing in international or euro currency markets, sourcing input products from overseas suppliers, and ultimately shifting production facilities to overseas. None of these are easy or cheap and can expose the company to new types of the risk. Okan will also need to assess that any actions it takes to manage economic risk fits in its overall risk management strategy. So, to manage this risk, it is not easy because the economic risk is a long-term risk. And what you can do, you can have the suppliers, your supplies you can import, your products, you can have the supplies for them from the other countries from where you can have it at a cheaper price. Or the other thing is, wherever your competitors are based, you may shift there. Now, how each category or risk may be managed. Risk which fall into severe and frequent category, this need immediate attention as they could threaten the company's survival or its long-term strategy. The aim here would be to reduce the severity of the risk and frequency with which they are occurring, which may mean avoiding certain actions or abandoning certain projects if they could profitable in the long term, where a company has a real option and does not need to take action which will result in high frequency and high severity of the risk. It may prefer to wait and see what happens. When the frequency of the risk is high but their impact is not severe, actions needs to be taken so that risk do not become severe in the future. For example, the company could put system into place to detect these risks early and plans to deal with them if they do occur. Where the same kind of risk occurs often, the company may decide to have set process for dealing them. For example, where there's a loss of relatively unskilled staff, the company may decide to replace staff quickly with casual workers, but also have appropriate training facilities in place. If there are the risks which are severe but only happen occasionally, the company should try to ensure against them. Contingency plans could be introduced to mitigate them. For example, if the IT failure are high, when a business decides to move into a new system, it could put appropriate contingencies plans into it. This may include secondary backup IT system or initially training new system on a few business units before undertaking a fleet role. And risks which are not severe and not frequent should be monitored and kept under review, but no significant action should be taken. It is possible that any significant action would incur cost which would likely to higher than the benefits derived from limiting such risk. So guys, I will say this was a very, very good question.